Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Monday, March 31st, 5:08 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Revere Roundup Daily Market Insight video. Market state, we're in a moderate correction. Check the trend gauge over here. Got to go all the way back to September of 2022 to see the loathed four red arrows. You either got the coveted four green arrows for a bull or the loathed four red arrows for bearish market action. We're technicians, so we can tell the difference. There's a lot of people right now telling people just never to sell. We don't know if the market is going to go 1, 2, 5, 7, 10, 12, 15% lower. We don't know if the bottom was put into today, but we've got a plan either way. You very often hear people derisively referring to what we call trend following, what they call market timing, saying, well, you got to be right twice. You got to be right on the sell and you got to be right on the buy. Well, yeah, and that's what the entire O'Neill system is built upon. Uh, all we know is that we rallied off of a low today, and this is day one of a rally attempt. But if you follow the system, there's really 9 steps we have to go through. I showed this a couple weeks ago, and it was 7 steps, but I added in some reference to the follow-through day. The first thing we need to do on the indexes is regain the declining 8-day moving average, then the 21. If those two things happen, there's a good chance we will have had an O'Neill follow-through day. That's got to be 4 days off of the low, today being day one. Then you don't want to see any distribution after that happens. We saw this last week. We had a follow-through day with a bit of an asterisk because of the heavy volume the Friday before with quad witching expiration. But we said in our videos, first thing we want to see is no distribution after that. We got a bad distribution day on Wednesday and then a follow-up on Friday. So any rally that was kicked off last week, it was completely dumped. So those are the first 4 things we need to do. And then it's a matter of regaining the remaining moving averages that were under and seeing the shorter term moving averages curl up through their longer term moving averages. So long way to go. We're nowhere near it. You can't call a bottom after today. For one thing, it was quarter end, and there's a lot of window dressing that goes on there. So what did happen today? After the ugly close to last week, a lot of concern about a gap down over the weekend as institutions took task of where they felt things were on their spreadsheets. A lot of uncertainty going into those spreadsheets. So that's always a negative for the market, which hates uncertainty. The only thing we do know is that on April 2nd, the tariffs, reciprocal tariffs, or non-reciprocal tariffs are going to be announced by the administration. And this seems to be a big moving target. And it's not something that the market likes to see. But coming into today, we got that gap down that everybody worried about. But a funny thing happened on the way to the graveyard. 15 minutes in, we put in the low and then rallied for 6 hours and 15 minutes into the close. That means higher highs and higher lows all day long. Anytime the bears tried to sell it off, I counted 5 times after 2 o'clock this afternoon. The bulls showed up with a bid. May just be quarter end dressing, but that's why we take it one day at a time, one step at a time here at Revere. So the bottom line is the gap down got bought by resilient bulls. Here are the numbers. No 21 over 21 list. And the fact of the matter is that we could slap 21 stocks on a list, but we're looking for a leaders list. And a lot of those leaders are under the 21. Some bounced at the 50-day. Some are right under the 50-day. Those are the stocks that have great fundamentals that we have our eyes on that could lead a bull rally, a market rally. But that list is under construction right now. As a team, we go through it every day, feeding or highlighting the leaders in this case, and getting rid of things that did lead that are failing, and marking things that are fundamentally strong and are showing relative strength. So here are the numbers on the day. The big eight down 0.4%. That is the Magnificent Seven, or people calling it the Lags Seven now. And Netflix, we included in our big eight, down an average of 0.4%. All of them gapping lower, but coming off the lows. The RG8s, our 8 growth ETF composite, again, all of them gapping lower, but coming off of the lows, but down an average of 0.5% today. The S&P 500 gap down with a down 1% at the open. And then, as I said, put in the low within the first 15 minutes and then just made higher highs the rest of the day. So after a trend down day on Friday, we got a trend up day today. We'll see what happens the rest of the week. NASDAQ lagged. Not a surprise to see the equal weight RSP outperform the S&P, which is typical when the NASDAQ lags. We'll look at the rest of the market indexes when we go through the charts. Global 60/40 up 0.12. Our flagship GROTECTION portfolio up 0.25% today. Let's get into the charts. Let's start with the NASDAQ 100 today. And one pattern that we're always paying attention to is the undercut and reclaim of a key level. We've been talking about this multi-week consolidation that we're in. We had a breakout above it last Monday that failed on Wednesday. Ugly days Thursday and Friday. Big gap down today, but then undercut and reclaim. So this is a shakeout type candle. It means that people panicked right at the 15 minutes, right after the open. Let's go to the 5-minute chart here, and you can see where we had a gap down and then put in the high within the first 20 minutes on Friday, and then a trend down day, lower lows and lower highs into the close. Complete opposite today, gap down, but put the lows in within the first 15, 20 minutes, and then higher highs and higher lows all day. So we basically ended up on the NASDAQ 100 where we closed on Friday. Let's go to the S&P 500 and show first. Same situation, trend down day on Friday, trend up day today, but actually 0.55% above where we closed on Friday. And again, a shakeout below the lows of 2 weeks ago, below this 5,500 level, back into the range. Here's the level that we drew last week. We, again, similar to the NASDAQ 100, broke above it and the 21 and the 200-day moving average. That was one difference from the NASDAQ 100. It didn't get back above the 200-day moving average. And then an ugly day on Wednesday, more weakness Thursday, very ugly day Friday, the gap down today, but then the undercut of the 5,500 and a positive day today. We're watching this 5670-ish level as a possible resistance level coming back up. That's about where the 8-day moving average is going to be tomorrow or the next couple of days. And that's step one going from bear to bull is to get back above the 8-day moving average and stay above it. We got back above it last week and the week before, but broke back below it. That's the short-term moving average. Strong trends stay, like, think back here, May, June, July of last year, they stay above the 8 and or the 21-day. And that's what we want for the market to be bullish, and we're nowhere near that right now. And then, of course, we've got all the moving averages. We want them stacked 8 above the 21, above the 50, above the 200, but nothing like that right now. So a lot of work for bulls to do. Let's go to the equal weight S&P 500. Did not undercut the lows from 2 weeks ago. So some relative strength there, not a surprise because the NASDAQ 100, big cap stocks held back the market cap weighted S&P, but the equal cap weighted certainly looking better and is closer to the top of this consolidation than it is to the bottom of it. Money flowing into value names today, a little bit of a rally toward the end of the day. In growth names to turn the growth half of the index is positive at least. But here's another value index. This is the Dow, and it finished up by 1% today and also did not undercut the lows from 2 weeks ago. So some divergence there. We've been noting how value names are outperforming growth leaders, and that's obvious from the relative strength line over the last 6 weeks on the Dow. Let's go to the S&P Mid Cap 400. Didn't undercut, a little bit of relative strength there. but long way to go to get back up to the declining 21-day moving average. And finally, the Russell 2000 small cap did undercut the lows from 2 weeks ago, back into the range. Long way to go to get to the top of the range, and all these declining moving averages and overhead resistance. Small caps are really lagging badly. So those are the major indexes. Let's go to inter-asset correlation. We'll start with the VIX. VIX gapped higher, closed near the bottom of its range. Today, it ended up 2.9%. How about the dollar? Dollar's been trading in a range, just barely positive on the day. How about precious metals? These have been leading. Gold making a third gap up high, getting very extended from its 21 and 50-day moving average. We talked a lot about that in-house today. We've been trailing this with a 21-day moving average stop, make some of that to an 8-day um, trailing stop. You can see how for weeks this trailed up above the 8-day moving average before a hard break. These hard breaks just come out of nowhere. You don't go up forever. I mean, we just don't want to give back a big percentage of this gain. You can always get back in. We did trim this a few weeks back and added it back when strength returned to it. May see a very similar situation on what we're doing there as well. Gold stocks, GDX, also continue to act well after an ugly reversal on Friday. They gapped down but rallied, undercut and reclaim against the 8-day moving average there. Silver, there was a lot of talk on the Reddit crowd that they wanted to do a silver squeeze today. And although it did close at the highs of the day, it still was basically flat on the day. There's a huge short interest in silver futures, is why that talk has been started. So that's precious metals. On to Bitcoin, continues to show relative weakness below the declining 21-day moving average, but did not undercut the lows from a few weeks back. On to bonds now. Broad bond index up on the day, long bond up on the day. That means yields coming off. The TYX, you can see down, but did close near the highs of the day. Same situation on the 10-year. That's our inter-asset correlation. Let's get to the tail of the tape. Deterioration from a stochastic perspective in the major indexes and the RG8. The fear and greed is at a 21. That's in extreme fear. Bull case, need to initiate a rally, obviously, and trend back above the 21-day. Those are two criteria that are listed in those 9 steps that I mentioned. Big news item on the day, or sorry, this week is going to be Friday's government jobs report, the NFP report. There was a couple minor data points that come out before then, but all eyes will be on the jobs report. Keys coming into today, S&P against the 21 and the 200-day, just not even challenging them at all. We're just too far below it. Day count, though, from 3 hard days down to up 1 after the gap down and positive reversal. 3 days below the 8-day moving average, 4 below the 21-day moving average. Expectations remain negative as long as we're below the declining 21-day moving average on the S&P and the NASDAQ. From a sector standpoint, all 11 sectors were positive. XLK just barely positive by the end of the day. Also, gold and gold stocks and retail stocks, as we mentioned. To the downside, semiconductor, software, biotech, and international names underperforming the U.S. indexes. No changes to the portfolio today. All we own is 10% SPLG, that's long S&P 500, TLT, that's the long bond, and gold and silver. Volatility adjusted beta very low, 0.16, and this is actually 0.93. Our rebar, that's balance. Revere estimated balance at risk. That's us getting all stopped out of everything or being fully hedged. So, but the bottom line on the day, gap down open, but it didn't go any further. This was after being 3 days down, another gap down, high possibility of a positive reversal, and that's what we saw. The bulls bought it up, marking day 1 of the rally attempt. Tuesday's keys, we'll be seeing if we can get any closer to the 21-day moving average on the S&P and the NASDAQ 100. Of course, we certainly want to hold today's lows on both of those indexes. Let's take a look at a couple of stocks that are holding up pretty well. Ollie, Ollie's Bargain Outlet, massive relative strength on this, breaking out of a double bottom base today. And they did a good reaction of their earnings report a week and a half ago. Well, one thing to note here is that they're buying up a lot of the Big Lots bankruptcy stores and products for pennies on the dollar. So that might improve their bottom line. And they've got a really good business model. Their stores are normally cash flow positive very within a few years after opening. So this may not just be a flight to quality; it may actually be a potential leader. So that's Ollie. EQT is an oil stock holding up very well. EXE, another one even stronger. Northrop Grumman down slightly today, but this has been acting well. A defense name. Let's see. Uber. This is an example of one that's below the 21-day moving average, right into the 50-day moving average. But the strong fundamentals, 2026 earnings up 36% with only projected to be up 36% with only a 16 PE. Great fundamentals. It's one that we have our eye on. And it's just an example of a name that's got the fundamentals, and we're just in the wrong market. DoorDash, another one, had a power of three set up last week, coiled at the 8, the 21, and the 50, attempted to break out of it on Monday, but by Friday, completely gave it all up, but finished at the top of its range today. This is another example of a stock with great fundamentals, has the potential to lead, but you got to get, as William O'Neill said, the most important letter in CAN SLIM is the M. You got to have the market at your back, or you're really just wasting your time. That's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. The phone's 855 Real Wealth. That's 855 732 5932. If you're interested in becoming a client, email my partner, Dan Stewart, dan@revereasset.com. And a reminder, we discuss everything that we do every night on video here. Our flagship portfolio named GROTECTION, designed to grow assets during uptrends. Things start to roll over. We back off the gas, tap the brake a little bit, but get extremely defensive if we start to break below, or now we've been living below for 3 weeks, below the 200-day moving average. This is where all historical, yeah, you could be hysterical if you're down 20% and you haven't sold. But historically, this is where all bear markets occur. It's just math. You can't be down 20% and still be above the 200-day moving average. So that's a signpost that we use for defensiveness. Once we're under there, what are we looking for? They say you got to time it right both ways. Well, great. We've got a plan. We're looking for an O'Neill type follow through day for ideally 4 to 7 days off the lows with some good fundamentally sound stocks coming up the right side or breaking out of sound bases. It's that simple. That's what we're looking for to get back in. We also use leveraged ETFs to participate in the indexes and smooth the equity curve. Right now, we don't own any of those. Any that we do are with big gains are hedged right now with a similar product. But that's the plan. We discuss it every night here on these videos. Stick with us to stay on the right side of the market. And with that, I'll wrap it for Monday, March 31st. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.